118,727. That is the number of U.S. properties that had a foreclosure filing in the first quarter of 2026, according to the latest ATTOM Foreclosure Market Report. That is a 26% increase from the same period 1 year ago. It is the 12th consecutive month of annual increases in foreclosure activity in this country. But inside that national number, one state is carrying a disproportionate share of the pressure. Florida posted 10,099 foreclosure starts in the first quarter of 2026. That ranks second in the country for raw volume. More significantly, Florida's foreclosure rate now stands at one filing for every 750 housing units, making it the third worst foreclosure rate in the United States. In Lakeland, that rate is 1 in every 409 housing units. In Punta Gorda, 1 in every 416. Both of those metros rank in the top 2 worst foreclosure rates among every major metropolitan area tracked in the country. This is not a warning about what might happen. This is a report about what is already happening. My name is David Cole, and I am the editor-in-chief of Housing Intel. This channel exists because the real estate industry has a financial interest in telling you things are fine. We do not. Subscribe now and join the people who are making decisions based on data, not on spin. Let us get into what the numbers actually show. The first thing to understand is what a foreclosure filing actually means, and why the trajectory matters more than the absolute level. According to ATTOM, a foreclosure filing includes all 3 phases of the process: the default notice, the scheduled auction, and the bank repossession. When a property enters the default phase, the owner is typically 3 to 6 months behind on payments. The bank has issued formal legal notice. At that point, the homeowner has a limited window to cure the default, negotiate a short sale, or face the property moving to auction. The majority of the public focus is on completed foreclosures, but the early-stage data, the default notices and lis pendens filings, is the leading indicator. That is where you see what is building in the pipeline before it hits the market as distressed inventory. Florida's foreclosure starts, again at 10,099 in the first quarter, were up 20% year over year. Bank repossessions in Florida were among the fastest growing in the country. ATTOM data shows Florida's REO count jumped from 487 in the first quarter of 2025 to 1,014 in the first quarter of 2026. That is a 108% increase in 12 months. The lenders are not just sending notices. They are completing the process and taking properties back at twice the rate they were a year ago. The second data point that anchors this story is what is driving the delinquencies in the first place. This is where the Florida story diverges from a simple national trend. According to Intercontinental Exchange Mortgage Monitor research, the Gulf Coast of Florida is experiencing a combination of factors that has produced an outcome ICE specifically flagged as concerning. Rising property insurance costs and a series of natural disasters have created elevated delinquency rates in the same areas where home prices have already pulled back from their pandemic highs. The result is negative equity. ICE Mortgage Monitor data shows that nearly 70% of 2023 and 2024 vintage FHA loans in Cape Coral are currently underwater. In Northport, 57% of 2023 vintage FHA loans are underwater. These are not projections. These are current readings from ICE's mortgage performance data. When a homeowner is underwater on their mortgage, they owe more than the property is worth. They cannot sell the home and cover the loan in a traditional transaction. Their options become limited to a short sale, in which the bank agrees to accept less than the outstanding balance, or a foreclosure, in which the bank takes the property back. The rising foreclosure starts across the Gulf Coast are the downstream result of this equity erosion working its way through the system. Before we get to the next data set, leave a comment below telling us which market you are watching right now. We read every comment, and your input shapes the reports we publish next. And if you know someone thinking about buying or selling in this market, share this video with them. It could save them from a very costly mistake. The third dimension of this story is the delinquency pipeline above the foreclosure data. Foreclosures do not appear from nowhere. They are preceded by delinquencies. The Mortgage Bankers Association's National Delinquency Survey, released in February 2026, for the fourth quarter of 2025, reported the overall mortgage delinquency rate at 4.26%. That is up 28 basis points year over year. But the more significant number is the FHA delinquency rate, which reached 11.52%, the highest level since the second quarter of 2021. The MBA specifically noted that the most pronounced uptick was in later-stage 90-plus day delinquencies, which increased by 76 basis points. And the MBA flagged that FHA loans originated in 2022 and 2023 are performing worse than earlier vintage years, which aligns precisely with the period of peak Florida home buying at peak prices with maximum leverage. In Florida specifically, the most recent state-level MBA breakdown showed Florida recorded the largest quarterly increase in overall delinquency rates of any state in the country at a single reporting period, up 99 basis points in one quarter. The trajectory established in that data has continued into early 2026. ICE's first look at March 2026 mortgage data, released in late April, confirmed that active foreclosure inventory nationally rose to 273,000, up from 213,000 a year ago. That is the highest foreclosure inventory level in 6 years. Foreclosure starts were up 17%, and foreclosure sales up 21% year over year in March alone. The fourth dimension is the short sale pipeline that runs parallel to but ahead of formal foreclosure completions. A short sale is a situation where the owner has gone into default and is attempting to sell the property before the bank completes the foreclosure process. The bank must agree to accept a sale price below the outstanding loan balance. The short sale pipeline is important because it represents distress that is visible to buyers, but not yet fully captured in foreclosure completion data. Active short sale listings in Florida are concentrated along the Gulf Coast, from Tampa south through Port Charlotte and Fort Myers, across to the Lakeland and Davenport corridor in Central Florida, and into pockets of the Orlando metro. Properties acquired at peak pricing in 2022 and 2023 are now being marketed through bank-approved short sales, at discounts of 15 to 20% from original purchase prices. The data documents specific cases in Osceola County between Lakeland and Orlando, where bank-approved short sale prices represent 21% reductions from the 2022 purchase price, with losses that the data suggests extend to the lender as well as the borrower. The fifth dimension of this story is what the data does not yet show, which may be the most important part. ATTOM CEO Rob Barber stated in the Q1 2026 report that while volumes remain below historical peaks, the continued rise, especially in starts and bank repossessions, suggests financial pressure may be building for some homeowners and could signal shifting housing market dynamics. That language is carefully measured, but the underlying trajectory, 12 consecutive months of year-over-year increases, bank repossessions more than doubling year over year in Florida, FHA delinquency rates at multi-year highs, and ICE flagging 70% of recent Cape Coral FHA loans as underwater, describes a pipeline that is still filling. An analyst at mortgage servicing firm DLS Servicing, speaking to National Mortgage Professional, described the current situation as a delayed reckoning after years of loss mitigation policy that allowed borrowers to defer their financial pressure, and characterized what we are seeing now as just the start. The context that prevents this from becoming a simple repeat of 2008 is this. The vast majority of Florida homeowners who bought before 2020 still carry significant equity. The overall mortgage delinquency rate, while rising, remains below its long-run historical average of 5.25%. Completed foreclosures are at a fraction of peak levels from 2010, when Florida's foreclosure rate hit approximately 9% of all mortgages. What this data describes is concentrated stress, not systemic collapse. The homeowners at the most severe risk are those who purchased in 2022 and 2023 at peak prices using government-backed FHA loans with minimal down payments in markets that have since seen 5 to 10% price declines. For those specific homeowners in those specific markets, the equity cushion that protects most Florida homeowners does not exist. The sixth and final dimension is what this pipeline means for prices in the specific markets where distress is most concentrated. Distressed inventory creates what analysts call a comp contamination problem. When a short sale or foreclosure completes in a neighborhood, it becomes a comparable sale. Appraisers use it. Buyers use it. Sellers trying to price their non-distressed listings have to compete with it. A traditional seller trying to market a home at $350,000 in a neighborhood where a short sale just closed at $280,000 is not going to get $350,000. They will either reprice, sit, or withdraw. The data shows that in the markets with the highest short sale and foreclosure concentrations, sellers with equity are pulling listings rather than competing with distressed comps. But that withdrawal of listings does not represent demand recovery. It represents a market that is pausing, not healing. And inventory that was pulled this spring will face the same competitive environment when it returns. Lakeland recorded the worst foreclosure rate of any major metro in the country in Q1 2026. Punta Gorda posted the second worst. Jacksonville ranks 11th worst among all U.S. cities with populations over 1 million. Orlando ranks 17th. These are not obscure markets. They are major population centers. The foreclosure pressure in those specific metros will continue to generate comp contamination, continued price softness, and continued absorption difficulty for sellers in surrounding neighborhoods. Here is what the data tells you when you read all of it together. Florida's foreclosure wave is documented, ATTOM verified, and building over 12 consecutive months. The mechanism is clear. Buyers who used maximum leverage to purchase at peak prices in 2022 and 2023 are now sitting in negative equity in markets that have declined. Their exit paths are short sales and foreclosures. Both pipelines are expanding. For homeowners in Florida with significant equity from pre-pandemic purchases, the trajectory of these specific distressed markets is important to monitor but does not represent an immediate threat to your equity position. For homeowners who bought at peak with minimal down payments in the Gulf Coast or Central Florida corridor, the data recommends honest consultation with a real estate attorney about your options before the foreclosure process advances further. For buyers watching this market, the distressed inventory pipeline is creating real transaction opportunities at documented discounts. The question is not whether those opportunities exist. The question is, which specific submarkets offer the most favorable risk-adjusted entry points? Housing Intel will continue tracking the ATTOM monthly data, as well as the MBA and ICE delinquency releases through the second and third quarters of 2026. The next ATTOM monthly report will give us a read on whether the Q1 acceleration is continuing or beginning to moderate. That report will be the most important near-term data point for understanding where this trajectory is going. Housing Intel publishes 3 reports every week, Monday, Wednesday, and Friday. Every one of them is built on verified data, not speculation, not opinion, not real estate industry talking points. Subscribe if you want the full picture, and share this video if someone you care about needs to hear it. We will be back with more.